Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Today we are discussing my plan for the rest of this decade until 2030. But before we go through that, you need to have a goal in mind. So the end goal in mind to allow you to then plan towards your goal. So personally, my goal is to have at least 100 rental properties in my lifetime. So then it allows me to then plan towards that goal. So as it stands today, the portfolio consists of 12 properties across New South Wales and Queensland. This consists of 2 townhouses, 8 standalone houses, and a block of 2 units on one title. So the portfolio is worth just over 5 million and we're carrying about 2.2 million in debt. So plenty of equity, good strong cash flow. But for us currently now, our serviceability is quite low. So only between 150 to 200,000 serviceability at any one time. And for me now, we're looking to buy larger assets of blocks of units, so blocks of 3s, blocks of 4s, blocks of 5s or 6s. And these types of assets start between the 450 mark up to $1 million plus mark. So in order to acquire those assets, we're going to have to focus on improving our serviceability to then allow us to then buy those types of assets that will complement the portfolio and allow us to keep moving forward towards our goal of 100 rentals. So like a lot of the institutions, such as Lendlease, Stockland and Meriton, they go through periods of acquisition. So they acquire sites, land or existing property. They then go through periods of value add or redevelopment, where they add value to the existing property to increase the yields through renovations or redevelopment, or they might just knock down and completely redevelop, or greenfield sites where they buy a farm and cut it up into smaller lots and then sell. They have 2 types of typical strategy, which is a build to rent. So they build property to rent out and hold, or they build to sell. So they acquire sites, they add value by redevelopment, and then they may sell those assets to cash in and recycle the capital. Or they also, say for instance, buy a block of land, build 2,000 units, sell 1,000 to pay off the block of land and the construction costs, and then keep 1,000 units and rent them out for the cash flow. So that strategy is what I'm replicating on a much obviously smaller scale because I've started from scratch. So as it stands today, out of the 8 houses, I can develop 6 of those houses. So by cutting the blocks in half and building a secondary dwelling in the back. And the block of units, I can also add a third unit on the back, or I could potentially even knock the block of units down and redevelop to build anywhere between 8 to 12 units on that site, because the zoning's already allows that, and the standard has already been set within the pocket where I own that block of units for building high density. So the plan is between now and the end of the decade is to going to now move through a phase of adding value. So to kick it off, I've already started by renovating two of my properties. This consists of new kitchens, bathrooms, paint, flooring, these types of things to boost the yields. I'm now got another house that I'm renovating in the next couple of months, which is going to consist of a new bathroom and tidying it up just to boost the rents. Currently renting at about $200, $280 a week, and by the time I renovate it and clean it up, put it back on the market, we'll be able to return about $450, if not $500 a week. So it's a good boost to the rent. And then I'll carry on through to start developing the standalone houses to add secondary dwellings in the back. The benefit of doing this is, instead of going and buying another house in the same suburb for 500, 600, 700,000, I can build a secondary dwelling for the 250 mark and then rent it out for market rate and then get the stronger yields. So then once I then build out and redevelop and add value to the portfolio, it'll substantially increase the cash flow, which will then ultimately increase my servicing. By that stage, later on at the end of this decade, I'll then be in a position to have strong servicing with strong cash flow to then go and allow me to continue to build and start acquiring again of more blocks of units. So blocks of 3s, blocks of 4s, bigger types of assets I want to add to the portfolio now. Now that I've acquired, got to the position I am now, to keep allowing me to move forward to my goal. So if you've been following me for a while now as well, I also do a lot of study on the 18-year real estate cycle. So I play my time, my investments and what I do in the portfolio based around that cycle as well. So now that we're entering the land boom, because I'm carrying already a high amount of debt with a number of properties already, by way of adding value and increasing the rents is not only improving the portfolio and improving my cash flow, it's also protecting the portfolio as well from the downside if interest rates continue to keep going, which they most likely probably will. You need to be able to stay in the game. So there comes a time where when you're acquiring, you keep acquiring until you come to your serviceability limits, and then it's a good time to then rethink and re-look at your portfolio, add value to ultimately boost the yields, the rental yields, because ultimately you live off that rental income, and you live off that cash flow, and you want to keep allowing the portfolio to be reinvesting into itself and allow it to keep moving forward, but also not protecting yourself from the downside of any downturn that we may go through towards the back end of this decade, post 2026. So now's a good time. Even if you're starting off, you got to start acquiring at some point. But once you sort of get to a stage where you've built a portfolio, it's good to then add value, boost yields, and then reset, and then go again. So thought that will give you a bit of context of my plans the next few years. Obviously this is a plan, so if interest rates drop and my serviceability increases, but there's always bargains, there's always good property to buy, and my position changes, of course I'll look to keep acquiring. However, in the near term, the next few years, I don't see interest rates dropping, and I more so see them continue to keep rising, because we're in a broad-based expansion, we're in a broad-based boom, and with limited stock in terms of new housing, prices are going to keep going. So now is a good time to start development. So thought I'd give you a bit more information. If you'd like to reach out, I'm happy to have a free 30-minute consultation with you to discuss where you are today and your goals, so we can help from a buyer's agent perspective. We source property across New South Wales and Queensland and help people build portfolios and scale out sustainable property portfolios to ultimately replace your earned income with a passive income for life. Thanks for watching.